And this is the problem that people are finding, is they put money in a 401k, you compound it at 10%. For my generation, that was how the world worked, and it was great, and it worked, and now it doesn't work. So they need assets that go up 50% a year, 100% a year, which is ridiculous, but luckily we've been gifted a few. And so that's helped.
Go on, say it.
Well, it's crypto. Simplistically, it just outperforms all other assets, even with the excess volatility. So Bitcoin, for example, produces since 2012, it's produced about 145% a year returns. So that's 10x the stock market. And that's including 3 70% drawdowns in the middle of it.
A drawdown being a drop.
Yeah. Well, you feel like you're an idiot, you're losing money, it's all going to go, you've made the biggest mistake in your life, and it recovers and it keeps going because it's a technological network adoption model that's happening.
Welcome, investors. In today's analysis, we're exploring the powerful macro thesis of Raoul Pal, who argues that the entire modern financial system is built on an optical illusion. The problem is simple but profound. Central banks create excess money, which systematically devalues the currency. This makes it look like scarce assets such as stocks and real estate are going up in value, when in reality, your money is just worth less. This creates a trap. While your salary might grow at 3% a year, the assets you need to secure your future are compounding at 12%, making it mathematically impossible to ever catch up. The old model of saving in a 401k is broken.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
Money is the medium of exchange, the thing that you buy something with. If we all have a lot of money, we've all got a stack of cash on this table, and you want to sell that mug, we can pay anything for that mug because we've got a stack of cash. Mm-hmm. So that mug suddenly is worth not the $10 it's supposed to be worth, it's suddenly we're paying $150 for the mug. Why? Because that money has no value to us because we've got excess money. So when you create excess money in the system, it's this debasement of currency. It's an optical illusion that the value of assets are actually going up. They're not. It's the value of your money is going down. And this is this pain point because your earnings only grow with economic growth generally, plus your progression of your career or whatever it may be. But those things, the scarce assets, are going up optically by the amounts they're lowering the thing. So what you find is salaries go up at about 2 or 3% a year. And the cost of the S&P is about 12%, 13% up every year. And a house price is about the same. Gold is about the same.
And that's because they're printing more and more money.
Correct.
Okay, that makes perfect sense to me. So I'm imagining you all have a big stack of paper in front of you, which you're using to take some notes on. And if I was saying, I'm going to sell you guys this mug for some of the paper you have there, but then my team said you guys can have unlimited paper, this mug loses value because you can all just offer a gazillion sheets of paper for this mug.
Well, it doesn't lose value. It optically will give you a gazillion for it as opposed to 3 sheets of paper because we've got so much paper. It matters not.
So I'll be thinking, wow, like this mug, it's worth a gazillion sheets of paper, but actually each sheet of paper is now worth nothing.
Correct.
Okay, got you.
And this is the problem that people are finding, is they put money in a 401k, you compound it at 10%. For my generation, that was how the world worked, and it was great, and it worked, and now it doesn't work. So they need assets that go up 50% a year, 100% a year, which is ridiculous, but luckily we've been gifted a few. And so that's helped.
Go on, say it.
Well, it's crypto. Simplistically, it just outperforms all other assets, even with the excess volatility. So Bitcoin, for example, produces since 2012, it's produced about 145% a year returns. So that's 10x the stock market. And that's including 3 70% drawdowns in the middle of it.
A drawdown being a drop.
Yeah. Well, you feel like you're an idiot, you're losing money, it's all going to go, you've made the biggest mistake in your life, and it recovers and it keeps going because it's a technological network adoption model that's happening. So it's just sucking in more and more people. So there's now 650 million crypto brokerage accounts in the world, which is more than all the stock market brokerage accounts added together in the world. And we're seeing it all around the world because everybody can buy a share of something. So as opposed to being able to buy, nobody can buy a Fifth Avenue apartment here, everybody can buy a fractionalized share of Bitcoin, which is, in theory, a $100,000 asset, But we can all put in $10, $5, $1,000, $10 billion.
Let me challenge it then. So Bitcoin isn't based on anything though.
No.
Okay, I'm being a fuddy here. Every now and then. That's my job. Bitcoin isn't based on anything. It is a database in the sky that isn't backed by gold, or it doesn't produce any sort of valuable asset as its byproduct. So how can we have faith in Bitcoin? It's essentially, in its essence, before someone clips me, I'm playing devil's advocate because I know they're just going to clip this part out. It is essentially, many would say, a Ponzi scheme, which is it only goes up if other people take part in it. And if everybody decides that it's not worth anything, then it's going to go to zero.
So all money is social consensus. Everything. Gold has no real value.
I can build a table with gold, though. I could rest some things on it, and it doesn't rust.
If you're building a table of gold, then the value is going to be much less. If everybody's building gold tables.
Trump has.
We do. That's true. And so really it's just social consensus. What do we as humans ascribe value to?
But the problem with the 145%, like you mentioned, Bitcoin has fallen by 70+% on multiple occasions. Let's go back to the S&P 500. A lot of people invest in the SPY, the S&P 500, and still lose money. Why? Because when we go through any downturn, people panic and they sell.
Yeah.
And if we look at, I think Bitcoin's 2009, when it started, if I'm not mistaken. If we look at the crashes from recent history, 2020 stocks fell by 30%, Bitcoin fell by 50%. 2022 stocks fell by 20%, the S&P fell by about 20%, Bitcoin fell by 60%. So in those times, people who are in the S&P are freaking out, selling.
Yeah, but here's the thing. This is the risk reward that people don't understand. If you've got a time horizon, let's say the average drawdown in the S&P during a bear market is 25%.
A drawdown being a drop.
Crash.
A lot, yeah, a drop in prices. You're getting compensated 15% a year returns for that, at best. In Bitcoin, the average drawdown over the same period will be about 70%. But you're getting 150% return.
If you're on the winning side, though. If I buy it and I can sell it for a higher price.
Just hold it.
That's the key.
All of these are in a nice trend channel. They go up. So anybody can buy something and hold it long enough, it'll go up.
Well, let's look at housing. We can say the same thing about housing. 2008, housing crashed. Just hold it. I have too much debt. I'm underwater. My bank's taking it from me. People are buying Bitcoin with debt.
Yeah, I mean, that would
2020.
I would not recommend that. But housing's different because you can endlessly create more housing. And we have a demographic problem in housing that makes it more complicated. Demographic problem is, A, everyone's leaving the cities now. B, the generational gap. Nobody can afford the boomer houses. We don't have enough cheap housing for young people. People are relocating, moving around. So we've got a very interesting mismatch in real estate now that makes it more complicated than it used to be.
Absolutely. And I do want to say, I think the part that we fundamentally differ is not that there's value in crypto. I own crypto. But the difference between you and I is you are all in crypto. For me, it's a speculative piece of my portfolio. So I invest in my own business. I have real estate, stocks, my speculative assets, and then a little bit of gold.
Imagine how difficult to replicate what you've achieved in your amazing career is for the average person listening to this versus buying one thing in your Coinbase account, your Robinhood account, and doing nothing. It's there's no cost. It's not like buying a house. It's not like servicing all the stuff. There's no debt involved. There's nothing.
The only rational solution to this problem, Pal contends, is to own assets that can generate the 50% to 100% annual returns needed to outpace this debasement. And there is only one asset class in history that has demonstrated this capability: cryptocurrency. He dismisses the Ponzi scheme narrative by framing crypto not as a belief system, but as a technological network adoption model. Just like Google or Amazon, as more users, institutions, and even governments join the network, its value predictably increases over time in a secular bull market. With over 650 million crypto accounts globally, more than all stock brokerage accounts combined, this network effect is already the most powerful and fastest in human history.
Bitcoin, since 2010, has done, I think it's about 90 million % returns. There's no asset in all human history that's ever generated as much wealth in the shortest period of time. And because it's not a random thing, it's actually a technology and it's a network model of technology. As more people use the network, and we see with Bitcoin, governments buying it and asset management firms buying it, and everybody else, you have this network adoption model. And so what it creates is the same chart as Google or Amazon, all of these. It just goes up in a log trend over time with some volatility. So you've got a secular bull market, which means that over time prices go up for measurable, understandable reasons. And it happens to be the highest performing asset of all time.
There's one problem.
And it's volatile. The psychological thing you're dead right about. It's very hard when it falls 70%. I've gone through 3 of those. They're hard.
The problem is, just like with real estate, everyone has said real estate only goes up. Well, how do you make money on that real estate? You make money when you sell, or you lose money if you sell. Ultimately, this comes down to that. You make or lose money only if you sell. Well, what about everything along the way? And what if I need to sell during that 70% crash? Because what happens during those crashes? A lot of times people lose jobs. A lot of times people lose their income. A lot of times people need that money during that time. And so now I'm desperate or I'm panicking. There's 2 things happening. And now maybe it's the end and I go in and now I lose money, thinking that I'm going to make all this money.
I think I can appreciate your love for cryptocurrency and your 100% concentration in cryptocurrency.
And I'm not
because
saying
you're
that's
in
suitable for everybody, right?
Right.
I've got the bottom of Maslow hierarchy of needs taken care of.
Right.
I've got houses, I don't have debt. It's easy for me. I've got multiple sources of income that I can take that back. I'm not saying that for everybody, but I can also understand why a 25-year-old can do that too, because they've got nothing to lose.
But do you think that if a 25-year-old puts their entire salary and savings into Bitcoin and they lose it, let's say they run through a 70% drawdown, aren't they just putting themselves in a bigger hole for their future as well? Like, maybe before there was a glimmer of a chance that they could that they buy a house, but then now they can't.
The most important part of financial markets is the least understood is time. It's not just price, it's time. So if you're 25 years old and you get wiped out, we've all done it. We've all kind of screwed up and, had to move home to our parents or do whatever. We've all done it. You can do that several times when you're young and it's okay. You just don't want to do it
at
when
age
you're
50.
At age 50.
Sure.
You really, really don't. You become more risk averse, generally speaking.
Okay.
So it just depends where you are and how much time you've got to take that risk.
But now if I'm investing my money in Bitcoin or really anything, a lot of the value is what some people refer to as like equity. I bought it for, I started buying Bitcoin when it was $3,000. That other stuff is equity. It's invisible money, which in my view is theory. It's not actual money in my bank account. It's sitting there waiting for me to sell, hoping that when I go to sell, it's going to be a profit versus cash flow. If I buy a dividend-paying stock.
What's a dividend-paying stock?
Some companies have big profits. For example, McDonald's has billions of dollars of profits. There's 3 things that they can do with that cash. They can save that money for an emergency. They can take some of that money and reinvest it and open more stores and create better burgers. Or the third thing that they can do, which some companies do, not all, is they can just give this money away to their investors, the shareholders. It's called a dividend. So it's a cash payment for doing nothing except owning that investment. So if I buy something, whether it's an ETF stock or whatever, that's paying a dividend, or a rental property that's putting money in my bank account every single month or year, that's money I can use to buy food, go on a vacation, do something. Here's what, let me tell you.
You're getting paid 4%.
Listen, so
Nobody cares.
I started buying Bitcoin at $3,000 a coin. When it was I went through multiple crashes. I remember when $20,000 of Bitcoin was oh my God, we did it. And once they hit around 70,000, I looked at this and I said, wow, I have my real estate, my stocks, my speculative, which is crypto and startups, and then 2% gold, which is now looking extremely inflated. I need to lower this. That way I can have some more income. So what did I do? I sold some Bitcoin. I bought rental properties. That now rental property is putting money in my bank account every single month. The Bitcoin, it's a big number on paper, but it doesn't actually mean anything unless I do something with it.
Could you have staked it, which means you can stake the cryptocurrency and make a monthly yield from it?
Get a loan against it.
Now, that's adding risk. Well, what happened if I take a 80% loan, 70% loan, let's 50% loan.
Yeah, it's very volatile. So let's
take a 50% loan. and Bitcoin falls by 70%, which it has, now I'm underwater. Now what? Now the bank comes knocking on the door, margin call, you're forced to sell, and it's a foreclosure.
My point being,
on my Bitcoin.
I mean, I don't disagree. And really speaking, people should have the ability to have cash flow or cash for if things go wrong, right? That's really a super important thing, to be able to have a long-term view, to be comfortable with drawdowns, to be able to invest in startups or to invest in crypto or technology and all of this stuff. That makes sense. But I just don't think a dividend at 4% makes any difference to anybody.
Well, it does if you do it consistently, month after month, year after year.
You need huge capital to start with to be worthwhile.
No. If you start investing for dividend income, I call it a decade of sacrifice. And this is why it's so hard.
Yeah, but if you're 33 years old now, you're sacrificing until you're 43.
You're going to become 43 at some point. And imagine if you're 43 and now you have the income to pay for that car, to pay for the house, you don't have to worry about it. Well, do you want to have hope that you have the Bitcoin, or would you rather have more security? Again, Bitcoin, in my perspective, high risk, high potential return. And I'm not saying don't buy it. No, I'm saying allocate it in your portfolio in a way where you understand you are arguably one of the top crypto experts in the world. I'm not. I also am not the stock expert in the world. I'm also not the real estate expert in the world. What I do is I'm probably going to be wrong. If my stocks crash, I have my real estate. If real estate crashes, I got my stocks. Crypto crashes, well, that's part of my speculative portfolio. I really don't care. And if everything crashes, I got some gold. So for me, I have to diversify against myself because I know stocks crash. I know crypto crashes. I know real estate crashes.
But if you're not starting with a lot of money, your strategy is the strategy of a rich person. Oh, I've got houses and I've got dividends and I've got some gold and I've got a bit of this. That's the strategy of being rich.
But I didn't start with all of those. I didn't start with all those at all. I started with one.
Where did you make most of your money? Being an entrepreneur. What were you doing? Entrepreneur. Taking obscene risk.
I did. That was me.
An entrepreneur is taking obscene risk.
But if I'm making $50,000 a year, the first step, let's assume now I'm putting $5,000 aside, $7,000 aside a year. I can take high risk, high potential return, or I can be conservative or a hybrid. And not everybody should be taking all the risk because Bitcoin has risks. And again, I'm telling you this, somebody who owns it. The government could come in and change policies on Bitcoin. Quantum could change Bitcoin. People could stop caring about Bitcoin. And if any of those things happen and all my money is in this very speculative asset, I'm the one that's carrying all the risk.
Pal directly addresses the key counterargument: extreme volatility. He acknowledges that 70% drawdowns are psychologically brutal, but frames them as the necessary and acceptable price you pay for the asymmetric reward. While a 25% drawdown in the S&P 500 might net you a 15% annual return at best, a 70% drawdown in Bitcoin has historically compensated investors with a 145% annualized return. The key, he stresses, is time. For any investor with a long enough time horizon, particularly the young, the ability to withstand this volatility is the single greatest determinant of financial success. It is a simple, accessible strategy. Buy one thing, do nothing, and let the most powerful network adoption in history work for you.